In this video, traders, we're going to look at which options you could trade if you are bearish on crude oil. Stay tuned. Hey traders, a warm welcome to you. So, at the time of doing this video, crude oil's taken a bit of a bashing. So, I've put together some ideas that you could perhaps implement if you were bearish on crude oil and you thought it's just getting started, you thought crude oil was going to continue for the next few months and really squeeze that final bit of the downtrend, flush all the longs out before doing something else. That's your thesis. Let's look at some different option trades we could do on that. If you've got a bullish thesis, check out another video I've done where we look at potential bullish option plays that you would have on crude oil. So these are kind of real examples with real prices at the time of filming. So it's just for kind of information purposes, just so you can see the kind of payoff you get for each of these. All right, so at this moment in time, crude oil, we're going to look at the ETF, by the way. We're going to look at USO, the ETF, purely because it's easier to trade options on generally, because if futures have got different contract expiries and options expiries, and it can get a little bit awkward. USO, loads of liquidity. It's an ETF that basically tracks crude oil, so we're going to use that. So current price at the moment on USO is $11. Well, it's actually $10.73, but it was $11 earlier in the day. So we're going to use $11 because that will then kind of make you think, all right, you can compare it to some of the puts and calls that I've picked out rather than using the 10.73. But just bearing in mind that the price is slightly lower than the actual current price when you compare it to some of the value of these options. So it's 10.73, but working on kind of 11. All right, and my thesis, or the kind of hypothetical thesis, is that we're going to go to $8 by January the 18th, and that happens to be the expiry date of the option. So we could go further out, we could go closer, but let's just pick that and let's just think that, you know, we're going to squeeze in through the end of the year, and New Year's going to continue, and that's our kind of hypothesis. So let's look at some of the things we could do. Now, let's get the pen out. First thing we genuinely could do is we could obviously sell USO. We could go short on USO and take advantage of the ETF. We could sell crude oil futures. But what about if we want to play in the options market? Well, there's three ways we could do it here. There's a couple more other ones that I'll talk about loosely, but I want to focus on these for this video. The first one is long a put. Now, a put option is the right but not the obligation to sell USO at a specific time, at a specific price in the future. So if we said, okay, we think that the price is going to hit $8 by January, but we kind of would want to play around and say, well, I don't know if it's going to go quite to 8. I'm going to pick a $9 put because I want to kind of get a little bit of expansion through. We might pick an $8 put, but $9 is kind of gives us a little bit of room. Let's say we thought that was the low from 2016. I think it was like $7.30, $7.50, something like that. So we thought that was close. Maybe $9 would be a little bit more sensible, a $2 move. So what we do is we buy a put. So we're buying a put option, our risk is limited, right? The most we can lose in this scenario, if we bought this $9 put, is 20 cents per contract. So we buy this, we go long at 20 cents, and how would we make money? So to make money on this, the market would have to be below $9. Well, actually, it would have to be below $8.80 to cover the cost of this by January the 18th. So if the market went to $8.80, let's say, what would happen? Of course, we would make $20 or 20 cents, sorry, on the put, but it's cost us 20 cents. So the put would be worth 20 cents because you've got the right, but not the obligation to sell something at $9 that's currently $8.80. You get it, the price, the valuation of that contract is 20 cents. So that's our break-even point, if you like, on that trade. So you can imagine if we go to $8, which is our thesis, we've got a nice 80 cents profit, okay, per contract we've traded, which is nice because if we bought it at 20 cents and it goes to $8, we're going to make 80 cents. It's a decent risk reward trade, and it's capped as well. If the price goes up to say $15, it doesn't matter because it's only going to be worthless to put, and so we've got completely capped risk on that, and we've got unlimited upside. Don't forget, because if this oil should completely tank and go to $5, then we're going to make, you know, much more money. We're going to keep making money every dollar, every cent that crude oil goes below that $9 level by January the 18th. And we've also got the option, don't forget, or the pun, maybe the pun was intended, maybe it wasn't. We've also got the ability to close the deal before the expiry. So if all of a sudden we just suddenly saw it blasting down, just ripping towards $9 straight away, let's say, you know, a few days just completely fell through the floor, and it was suddenly trading at $9, then that put's going to be very, very valuable, because if it's suddenly trading at $9 now and it's still got a lot of time to expiry, that thing could be trading at $1.50, something like that. So you know, that's something to consider, and that's off the top of my head. Who knows what that could be trading? The point is, it would be valuable. So you've got the option to close that before expiry. That's one way of doing it, buying that put. Another thing you could do is, if you perhaps weren't super bearish. Obviously, the downside of this is the market's got to go reasonably lower. You've got that 20 cents, it's got to go to 8.80 before you even start making money, and then even to make your money back, it's got to go to 8.60, etc. It's got to actually move. And don't forget, if it's currently 11, it's got to move reasonable amount of distance towards 9 before you start making any cash at all. So you're not making any money between $11 and $8.80, and it's currently 10.73 or 11, whatever, how we're rounding it up. So that's something to bear in mind. You've got to have that first initial hurdle overcome before you start making cash. All right, let's move on, guys. Another thing you can do is, if you thought that was a bit too bearish, you still had your $8 target, and let's put that kind of out of the way so we can see that's our hypothesis, if you like. We've got a short call. So a short call is basically selling a call option. Just a quick reminder, call option is the right but not the obligation to buy something at a specific price at a specific point in time in future. So let's have a look at a call option, $11 call option. That would be the right, again, we're looking at January 18th, that would be the right but not the obligation to buy a USO at $11 at January the 18th. This is currently at $11, or give or take $11. It's 10.73, got close enough. It's currently trading at 0.69. So we are taking the other side of that trade. We are selling that contract to somebody, and they are paying us 69 cents for that. So we're receiving that 69 cents. So we could do that. Or we could go a little bit higher. We could say, well, you know what? We think that maybe crude oil might go lower, but it might stay where it is. So I'm not super bearish, but I just don't think it's going to go much higher. And we could sell a $13 call and we get 14 cents for that. So why do we do that? And what's the sort of scenarios of this? So let's assume we'd sold that $11 call. Basically, you know, with the right but not obligation to buy USO at $11. If the market stays at $11, what's the call option worth? The call option has no value. We receive that full 69 cents in our pocket because that's what the buyer has paid us, the premium for that option. And in fact, our break-even point is going to be 11.69. Okay, if we put a break-even point at 11.69, you can see why, because anywhere between up to there, if it's 11.69, what's the value of the call option? 69 cents. Well, they've already paid us 69 cents. That's the break-even point. So it's not quite as bearish, obviously, as this long put, but it's the maximum we can get for this, or maximum payout, is going to be the premium. So basically, anything below $11 is full profit for us. Can't make any more. So if it goes to $8. When our thesis was $8, don't forget, we're not going to make any more than the 69 cents. So we might not be quite what we want. But the advantage of this over that long put is that the market can just stay and stagnate at $11, $10, $10.50, even creep up a little bit, and we'd still be making money on that. The downside, of course, is this. If the market should suddenly rip to the upside, that call option will be super, super valuable. If, for example, we ripped straight up to $12, what's going to happen? The value of that call is going to be $1, and we're going to have to pay out the difference of that $1. So we're going to have to pay out the buyer of the option, who's going to surely is going to exercise the option. He's going to say, hey, I can buy something at $12 for $11. Yeah, I am going to buy that. So we'd lose the difference between the $1 and the 69 cents we received. You still receive that premium. But then don't forget, we're still on the hook for any further moves higher. So let's say it goes to $15. It goes to $15, all of a sudden that call option is going to be worth $5. Yes, we received 69 cents for it, but whatever, $31, $4, 31 is our loss on that, which is pretty significant and could still go higher. So that's something to bear in mind, guys. We're on the hook for anything that goes further and further on. That's why we might decide to sell something higher out. We might decide to sell a $13 call. That's not specifically that bearish, but it means that, you know, what's the chance of going to 13? A lot lower than it is of going to 11, because it's currently 11. That's why the option price is far cheaper. We collect that 14 cents unless it started trading above $13 at expiring. which case we'd have to pay out again for every cent increment above the $13. So a break even of that one would be $13.14. Okay, so another thing we could do, final one very quickly, is the bear put spread. So let's say, for example, we wanted to kind of trade around this and buy this put, but we didn't really want to pay the full 20 cents. And we didn't think that this thing was just going to rip through the floor. So what we could do is we could buy a put option. So we'd buy that put option at 20 cents, the $9 put, the same one as there. That's the same kind of scenario as we had there. But what we would also do to reduce the price a little bit is we could sell or go short. Let's put one of these options here. We could choose an $8 put or a $7 put. Now, let's say, for example, we were very precise with this and we thought, you know what, this thing is going to sit, it is support. We're getting by January the 18th, it's going to sit there. It's going to be, you know, about $8. I think it's not going to be lower than $8. So this might suit us better because that gives us unlimited kind of downside or unlimited downside on the market, but upside for us. But this $8 put, if we sold this, what we're doing is it's costing us 20 cents. We're losing 20 cents by buying that put, but we're also receiving on this one 8 cents. Okay, so we've got 12 cents. The total cost of that is 12 cents as opposed to 20 cents if we just bought the put. Now, the good thing about that is obviously it's reducing quite significantly our trade. However, it does mean that if the market goes any lower now than 8, we're not going to make any more money. There's a cap on our profit, and our profit is obviously going to be, if we think about it, if it goes to $8, what's going to happen? So let's put it on here. So if it goes to $8, our $9 put is going to be worth $1. Okay, let's see if we can put it in here. It's going to be worth $1, and our $8 put is going to be worthless. So that's really, really good for us because the $9 put is going to be so $9 put is going to be $8. $9 put is going to be worth 80 cents for us net because we paid 24. It's now worth $1. The $8 put is worthless, but we sold that, so we get 8 cents. So we're going to make 88 cents on that, which is pretty decent. You know, considering it's only cost us 12 cents, the payoff is pretty high. You know, 88 cents, 12 cents, pretty good. And you can see that if we just did this with the puts, then we wouldn't make anywhere near as much and it would cost us a lot more. So the risk reward ratio would be far skewed. However, the downside of this is that if we went all the way down to, let's say, you know, $5, then we're not going to make any more because the put option here that we've sold is going to be more valuable. Because you think about it, at $5, it's going to be worth $3 that. So we're going to lose $3 on that put option. But don't forget, we'll make it each dollar it goes below that on the $9. So it's basically negated. Anything below $8 is negated, cancelled out. So the maximum we can make is that difference, is the 88 cents. So there's some options for us, guys. If we were thinking crude oil was going to move to the downside, long put, short call, bear put, spread. There's other things that we can do, but there's kind of the broad overview of potentially how we could profit using options on crude oil with a bearish thesis. Take care. Bye-bye.